options, that's what area I'm talking about.
By giving out employee stock options, doesn't it dilute the overall stock of the company?
It does, yes, and there is a criticism of that, but essentially, if they grant the options and the person exercises them, then the company, in fact, sells shares to the person at a price that's lower than the current market price. But the company gets cash for that, and they also get a tax deduction, both of which offset that dilution. And they don't get diluted if the stock is below the exercise price throughout the time, because the employees do not exercise their rights to buy the stock at 50, maybe when the stock is trading at 45. You see, so yes, one of the criticisms of granting equity compensation and employee stock options is that it does dilute the total number of shares, or it increases the total number of shares, and it dilutes the earnings. And so, but the thing is, the companies are not paying these people cash, and therefore there's a trade-off. You see, they're effectively selling the stock to their employees at a beneficial price in lieu of giving them cash.
I totally get that part.
Okay, and so there's criticisms of companies for giving large amounts of equity compensation, and that's what you hear all about with all of these companies getting their CEOs and the CFOs and the big executives, all of these large 10s and 20s and 50 millions of dollars for annual compensation. You see, and so, but what I've written articles about that, and I made observations of how big some of these payouts are, and you've seen some of those. For example, there were hearings before the Senate committees where guys were being questioned about their compensation, and to me, these guys were outright lying about how much they got, because they diminished the value of those grants in a way which they might be able to defend that if they were put under a subpoena or charged with lying.
How's that possible? Isn't whatever's written down what's written down? You either have X amount of stock or you don't?
Well, you see, there's a lot of disagreement as to what the options are worth. If you're loaded up with 1 million options to buy the stock at 25 and the stock's trading at 25, well, what is it really worth? Now, there's theoretical pricing models that can tell you what it's worth in a theoretical sense, but these guys can say, well, it's not worth that to me. You see, and so they can say, instead of that being worth $5 million, they'll say it's worth $1 million. And so those guys who testified before Congress, and I'm talking about the CEO of J.P. Morgan and the CEOs of Citigroup, Wells Fargo, Morgan Stanley, they all lied in a big way, because I know how to calculate it, and they have people that know how to calculate it too, but they just figured nobody's going to really question it, okay? But nevertheless, I think generally granting all of these stock appreciation rights or options or restricted stock has been abused. And one of the ways that's in the public domain about the abuses is what they call backdating. Backdating is when they might have had a formal grant of 1 million options to buy the stock at 30, and then a couple of months later the stock goes to 25, and they say, well, let's just change the date to make now today's date the date of the grant. And so, yeah, okay. So they changed the date to 25 when they were really granted at 30.
Who would be the one to change that?
Well, that would have to be cooperation between the guy who's getting the options and the compensation committee and maybe some lawyers. And a lot of these people were charged with crimes out in San Francisco, and I think the FBI convicted a few people there. And but I think nationwide there was litigation and criminal charges all over the place. And now, as far as how many, a lot of them were settled, I guess, but that was the most obvious cases of it, and they couldn't really defend doing it. They might have. Some people say, "Well, yeah, we did it. We changed it, but it wasn't illegal." But they charged them with crimes anyway, and some were convicted, and some weren't, and some settled. But there's another way that they do that. You see, the idea is to really extract as much as they can from the company. All right, and they do. They know if they grant options with a lower exercise price. In other words, the lower the exercise price, the better for the guy who is granted the options. In other words, if the stock's trading at 50 and you have the right to buy it at 50 for the next 10 years, well, that's worth a certain amount. But if you have the right to buy it at 40, well, that's worth quite a bit more. So they'd rather get it where they get they are granted the rights to buy the stock at 40 than the right to buy the stock at 50. And so you can see a lot of cases where very large companies now bought the stock or were granted options on the lowest price for the last 5 years. In fact, that happened to J.P. Morgan in 2008, 2009. Now, right at the bottom of the valley, loads of grants of employee stock options were granted to the top executives. Okay, and so, and I'm talking about very low prices, which 2 years later the stocks doubled or even more. You see, so is it just an accident that they were granted these options right at the low? Well, it's harder to prove that they manipulated the stock down to accommodate the grants of these big executives than it is to catch them doing backdating. So they do that more than they. Okay, but I'm just talking about my observations. I don't have any real activity relative to that other than writing a couple of articles. And also, but there are some people who watch the previous times that these options are granted. In other words, if options are granted to people in, say, the middle of March every year, then what they try to do is they anticipate that they will manipulate the stock lower so that they can grant these options to them at an artificially low price. And so if you can kind of get an idea when that grant's going to take place, you can go short the stock 3 weeks before and then buy it back when they grant the options because you're anticipating it to jump back up.
Don't you think, John, that the entire options realm, the way that you're describing it being abused, the fact that that capacity is available to manipulate, doesn't that make owning a company and growing a company polluted from the get-go?
Well, yeah, assuming they're doing that. Now, that's not to say they all do it, but there's some very big companies that have been accused of it. Now, I've mentioned Google, and I mentioned before J.P. Morgan, and you can find a lot of them. Yahoo, for example. You can go back and look at when the CEO was granted the options, and you just see that it's right at the bottom of the valley. And yes, they're extracting money from the companies, and that makes it such that if you're an investor, if you see what's going on, you're less likely to buy shares in that because they're taking some of the earnings for themselves.
John, how would an investor who's looking at investing in a company verify if this is going on? Is there certain books that have to be shown? Are the contracts accessible to investors?
Yeah. You see, every transaction that officers and directors make has to be reported to the SEC within 2 days, and you can find it on the internet for free. In other words, if you're thinking about buying some stock in a company,